Okay, welcome back to part 2 of IAS 12 income taxes and deferred tax. Okay, so we've dealt with the tax rate, whether 28% and 22.4, the income tax rate change, the assessed losses, but not in detail, the recognition of deferred tax asset, deferred tax liability. We've dealt with the definitions. Okay, so now I want us to quickly look at items recognized in P&L and items recognized in OCI versus, okay, and then we also look at the income versus balance sheet method, and then from then we can quickly move to the example that I have for you guys. Okay, so quickly, here's what is happening. We know that our statement of profit and loss and comprehensive income, whatever, is divided into two. We have items in P&L and then we have items in OCI. That upper part and the bottom part of the income statement. Okay, fine. So if the item is recognized in P&L, what it means is the related deferred tax of that item should also be recognized in P&L. Okay, if that asset or whatever you are dealing with is recognized in OCI, it means that also the deferred tax related to that item should also be recognized in OCI. For example, let's make an example about land. The land is let's say it's carried at the revaluation model. Okay, so the cost is 100,000, and then we revalue it to 150,000. Accounting, we debit land, we credit a revaluation gain at OCI. That revaluation gain is an income that goes to OCI. So the related deferred tax of that revaluation gain, 28% multiplied by that 50,000, should also go to OCI. Okay, that's what I wanted to tell you about this. And then obviously calculating deferred tax comes into two forms. You can either calculate deferred tax using the income method, or you can calculate deferred tax using the balance sheet method, but preferable, myself, I love income method. I think it's short and straight to the point, and someone else will tell you that they love the balance sheet method for their own reasons. Okay, but for me, income method, it's just straight to the point, because if you're dealing with leases, for example, you need to, not specifically for leases, but for everything that you're doing. Income method says just reverse whatever an accountant has done, okay, and put through whatever the tax legislation says you must put through. Okay, and then the difference between those two, they give you a deferred tax. Okay, which is the reconciling between taxable accounting profit and taxable income. That's it. So, but the balance sheet method, it compares the balances from 31st December 20.20 to 31st December 20.1, whatever. Okay, and then you do the movement between the two. So if you love balance sheet method, that's fine with you, just go with balance sheet method, but income method, it's the best for me. Okay, so but obviously there is no exam paper that's gonna tell you you need to use income method, you need to use balance sheet method. You decide for yourself which one you think is gonna be best, which one you think it's gonna be quick. Okay, now let's move to this. Let's talk about the tax expense note. What happens in here is tax expense that you see in your income statement is made up of three things. You have your current tax, which is obviously due to SARS, which is obviously as per the tax legislation. Okay, and then you have deferred tax, which is obviously as per the accounting standards. Okay, and then lastly you have the over or under provision of tax. So let's say if this year we estimate that our liability to SARS is 50,000 rand. Okay, and then come next year, next financial year, we realize, but no, actually we underestimated this. the liability to SARS is actually 70,000. It means we underprovided by 20,000. So last year, now that 20,000 needs to come to the current year and increase our tax expense. But if it was an over provision, it's obviously the vice versa. Okay, fine. So let's, okay, this is the tax expense note, and then this is the rate reconciliation. In the rate reconciliation, obviously at the statutory rate of 28%, you start with the profit before tax, you're exempt, you're non-deductible, but my point of focus, it's these two. It's these two, the assessed losses, the rate change, and unprovided assessed losses. Okay, so these items are not exhaustive, just so you know. Okay, so the rate change, what happens in here is, as I explained, that you have a deferred tax asset, say of 30,000 on 2020, and on 2021, okay, this was a 20% rate, and this should be a 30% rate. Okay, so this is 2021 opening 2021 opening, obviously, and then this is 2020 closing, obviously. Okay, so what this says is, if the rate changes now, that 30,000 need to be it has to be remeasured, because it is 30,000 28%. It has to be remeasured and reflect 30%. So what you can do is, you can say equals to 30%, because now it's 30% over, it was 28%. Okay, and then you multiply by your deferred tax asset, and then this is what you get. You know that now your 2021 opening balance is this. It means you need to increase your deferred tax asset, and obviously debit your deferred tax asset, and then you credit the deferred tax income. Okay, so this should be equal to this minus this, and then this is the expense for the year. This is the deferred tax income actually for 20.1. So whatever expense you have for 20.1, just don't forget to put this through. Okay, and also in your in your reconciliation, this 2041 needs to come here. Okay, and since it is decreasing your tax expense, it has to come here and decrease the tax expense. Okay, so now let's go to, I hope it's clear, and if it's not, you guys feel free to drop a comment and tell me which part you need me to explain further. Okay, now unprovided assessed losses. Okay, let's read assessed losses separately. Here's what is happening now. We have an example. Just keep in mind, remember I said to you, a deferred tax asset should only be recognized if we know, or if it is probable that future profits will be made against which to realize the deferred tax asset. Okay, if you look at this example, in 20.1 we made an assessed loss. 20.2, same thing, we made an assessed loss again. Is this thing? Yeah, we made an assessed loss again. Okay, so yes, we made an assessed loss again, and then in 20.3 at least we made the profit. So this means that the deferred tax asset for 20.1 and 20.2 should be controlled as per the standard, should be recognized to the extent that we expect future profits. Okay, let's go. Let's look at the example. We have a deferred tax XLTD had a deferred tax balance of 16.8, credit balance, which is deferred tax liability, as at 31st December 20.0. Okay, and then these are tax computations for 20.1 to 20.3. Wonderful. Okay, let's do this. We have Okay, we're gonna use this table to address or to do the assessed losses thingy. We have deferred tax balance, and then we have other temp differences. We have assessed losses provided for. Okay, and then we have assessed losses unprovided for. Okay, here's what's gonna happen, or here's what I want you to know. Okay, just so you know, this is a balance, whether it is debit or it is credit. Okay, and then this, okay, one thing I need you to know about this thing, you should know that this whole tab or this whole column of assessed losses unprovided for, it's only for disclosure purposes. Ne? As you see in here, that unprovided assessed loss is part of your rate reconciliation. Okay, and here the balance, the year-end balance, it's the balance that you're gonna recognize in your balance sheet. Okay, and the movements of this, they give rise to your deferred tax expense or your deferred tax income, whatever it is. Okay, one other thing to note is this thing is equal to this plus this. Okay, just remember, this is equal to this plus this. Means this is equal to from what I wanted to do, but this is equal to this plus this. Okay, wonderful. So now let's go to our example and try to do it. We are given a deferred tax. Okay, one other thing before we move forward. So now debit, obviously it's a deferred tax asset or a temporary or a deductible temporary difference, and credit is a deferred tax liability or a deductible temporary difference. So you need to make a decision now, whether are you gonna make the deferred tax asset negative, or are you gonna make the deferred tax liability negative? So I prefer making a deferred tax asset or deductible temporary difference negative. Okay, and then we make this one positive. Wonderful. So let's start as at 1st December 20.3 as given. So we have at 1st December 20.3. Okay, and we're gonna have, they told us that we have a deferred tax liability of 16.8. So we said liabilities are positive, so we have a deferred tax liability of 6.8. Okay, and then we have, okay, we have a deferred tax liability. To me, it says that for the fact that we have a deferred tax liability and nothing talks about the losses, it means we did not have any assessed losses in that part, in that period. Okay, so obviously this is nil also, so we know that this plus this should give it this. It means in here we have also 16.8. okay, you also have 16.8. okay, now we move to, I hope that is clear for now. Let's have a movement. Let's have a movement for 20.1. Sorry guys, this is 20.0 for 20.1. Now let's look at 20.1. Here's our 20.1. We have a temporal difference of 10,000, which is positive, and there is a deductible temporal difference. Remember, deductible temporal differences are negative. So let's pull through. We have that 10,000 multiplied by 28%, which should give you minus 2.8. okay, and the next step is to add these two. okay, so 16.8 minus minus 2.8 should give you 14,000, if I'm not mistaken. Should give you 14,000. If this gives you 14,000, remember we have an assessed loss of 110,000. So now we need to calculate our assessed loss. We have 110,000 multiplied by 28%, multiplied by 28%. Okay, this gives you 30,800. That assessed loss, this is a deferred tax. Sorry, this is a deferred tax asset. Okay, it's a deferred tax asset. Remember, only recognized to the extent that they are future profits or to the extent of deferred tax liability. Okay, so now we need to limit this 30,800 deferred tax asset. We have exhibit temporal differences of 14,000. Okay, it means we need to provide for this deferred tax, for this deductible temporal difference to the extent of 14,000. It means we need to have 14,000 in here. Yeah, minus 14,000. Obviously, y is minus a deferred tax asset. It's debit to, if it's provided, it's debit to deferred tax asset, and then you credit to deferred tax income. Hence, it's negative. Okay, wonderful. And we do this. So if we provided for 14,000 but we had 8,800, this means that we have not provided for 80,800 minus 14,000. Okay, so if that's the case, it means 30,800 and you subtract 14,000, we have an unprovided for of 16.8. Obviously, we know this plus this should give you this, which gives us 0. And to get to here, to get to minus 14, it means we also had minus 14 in here, and to get minus 3, it means we also had minus 16.8 in here. Okay, so obviously this and this, it's 0. It means this and this should give you 0. Then we have minus 16.8 in here, and obviously if you check this against this, it should give you minus 16.8. okay, that's it for, it should give you minus 16.8. okay, now I think, okay, this is 31st December 20.1. okay, so guys, just take a moment, process this thing, and get ready for part 3, where we're gonna be doing 20.2, 20.3, and we close the class for the day. Okay, thank you.